The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Well, it felt like deja vu in the row crops on Wednesday. Corn and beans were pretty quiet. We did extend a little bit to the upside in beans into the close on Wednesday, but it was still overall a quiet day there. The wheat trade, though, found some pressure on Wednesday, giving back Tuesday's gains and then some. And it's been a pretty tumultuous week in the livestock trade, particularly in cattle. We're going to talk about all that and more. Joining us today for conversation, Mike Zuzolo with Global Commodity Analytics. And Mike, good to talk with you again here this week. Thanks for joining us.
You bet, Jesse. Thanks for having me.
Well, as I mentioned, it was pretty ho-hum in corn and beans on Wednesday. We'll get to that side of the grains in a little bit, but I think we should start with the wheat trade. And I know you do a lot of analysis and work here in the wheat markets, and there's a few things going on. And we saw double-digit losses in Chicago. KC spring wheat was right there. We got things going on with currencies. Of course, there's a lot of talk about that this week with the Jackson Hole meeting. We got this potential rail strike in Canada that I know we'll talk about in a minute. I guess set this up for us. What was your perception of some of these things swirling around the wheat trade on Wednesday?
Yeah, I mean, you hit all the big ones, and this is where we're coming off the WASDE report. The wheat, once again, showed us last week it was the leader. If it were going to bottom, it was going to be the wheat that needed to lead us higher. This week, we're seeing it again. And so there's a lot of people that really weren't believers that wheat leads this market, specifically the European wheat, which is the first domino that needs to fall in terms of changing the price trend. But once again, we find ourselves literally just pennies away from the 2024 annual low in soft red wheat. And you hit the big ones. We've got a lot of tailwinds in this market right now at midweek here, Jesse, but it seems like we're facing more headwinds. And that's because at the end of the week, we get so much more new data. You're right. We got the Fed minutes today. They clearly showed the vast majority of the Federal Reserve governors and presidents and voting members want to go after a rate cut in September. A dismal annual revision to the jobless data, over 800,000 jobs gone versus the prior release. That's the worst number since 2009 as far as revision of data on jobs, increasing even more the likelihood of not just a rate cut in September, but more to follow. But yet we've got Jackson Hole. In Jackson Hole, you don't get all the information until kind of the end of the week. So that gives you the currency flavor and what's happening with the dollar and the fact that we've made fresh 2024 lows today in the index. The next thing is that railroad strike. Thursday midnight deadline on the railroad strike. It's starting to take hold, I think, in the agriculture, starting with cattle on Tuesday, wheat, and I think the vegetable oils now at this point. And I'm seeing some slippage in the U.S. river basis. We just can't underestimate. And you had a great show with the Stone Fertilizer. Big shout out to you guys when I was on the road last week talking about this, one of the first people to talk about it. And I started monitoring it probably a week and a half ago. The market's not ready for this. And I think that's exactly what your Stone man said. And I couldn't agree more. And I think the grain market and livestock market starting to wake up to the idea that this could really back up supplies. And it starts with spring wheat because of the West Coast. So that, again, end of the week, we'll know whether it happens or not. Trade right now, I think, is assuming Canada will not let it happen. And if it does, it's only going to last 24 hours. But this is the worst time of year for this kind of thing to happen. Last thing I'll hit you with is the crop tour. A lot of data right now, but we know how important those final numbers are to the trade at the end of the week. So tailwinds right now, but will they turn into headwinds come Friday? And that's why I think we're where we're at right now.
Yeah. Let's go through some of this a little more too. And I just pulled this up. You sent this map to me. This is the KC, a CPKC map. And this, along with Canadian National, I mean, you look at the scope of the impact this could have. And this isn't even including Canadian National, but this could be such a huge deal, especially Yeah, I think spring wheat there across the northern plains, the Dakotas, and Minnesota. You mentioned cattle, though, too. I hadn't thought about that in terms of the cattle market as well. So, big issue that we're going to watch. You sent me some charts, though, too, that I want to talk about a little bit. Let's look at SRW versus the dollar. And you were kind of alluding to this a little bit ago. Walk us through some of what we're seeing here midweek right now.
Yeah, I mean, this is where it goes back to on that rail strike with the cattle specifically, and this sets us up on the wheat in terms of my logic, my analysis that I'm doing this week, Jesse. We bring in about 505 million pounds year to date of Canadian beef. We send them about 131 million pounds. And so the idea would be if they're going to shut Canada down, and that's what they're talking about, 80%, roughly 80% of the all railroads shipments in and out of Canada that originate from Canada, that's on this rail line. You're talking about shutting down 80% of the whole rail system in Canada. You're talking about $400 billion roughly Canadian of traffic that you're going to shut down. I've seen numbers from 5% of GDP to 20% of GDP that this is going to shut down. So getting back to the ag commodities, I'm sitting here thinking to myself, if we bring in more beef from Canada, why aren't cattle going sharply higher with this idea that we won't have supplies, that we won't be able to get the grocery stores taken care of, especially in the northern part, in the northeast of our country. And yet we had limit down moves at times on Tuesday's trade in feeders and fat cattle. And I think it goes back to that map and the idea that the feeders are not going to get fed in the feedlots. The hog and poultry feeders in Mexico could be disrupted because it's all part of the same supply chain. And I'm wondering if the trade wasn't really starting to get nervous in livestock, that we were going to have a situation where marketings were going to be pushed forward aggressively just because feed was not going to be available due to the strike. And that's why this wheat and this dollar chart is so important. We're 4 cents away from the 2024 low in soft red wheat. We're back below last year's lows, and yet we're seeing trimming and trimming and trimming of crop supplies around the world. Last we saw was USDA's report just a week ago, and the dollar's starting to curl lower. There's a really strong relationship in this chart. When the dollar's weak, the wheat tends to want to go higher and vice versa. So there's a disconnect here, and I'm going to put it at the feet of the currencies because the Russian ruble was not strengthening against the dollar on Wednesday, and I'll also put it at the feet of this rail scare that we're having now.
You mentioned the ruble. I'll pull up a chart looking at that, SRW versus the ruble. And I mean, I've been seeing a lot of this as well here the last couple of weeks. A lot of the competition with European supplies and some of the different challenges and price action in Europe, that's been a big weight on the U.S. markets here as of late, Mike.
It is, and it's the first domino, as I said a minute ago. The European market, Paris wheat is still running roughly 75 cents higher than the U.S. Chicago Mercantile Exchange wheat futures at soft red wheat country. But what we're looking at is a 5-month low, a fresh 5-month low in the EU Paris market, even though the euro currency was shooting higher against the dollar on Wednesday. And the funds in Europe, the Paris wheat funds, are now, over negative 100,000 contracts net short futures and options. That's making up about 56% of the total short positions. Funds are getting shorter in Europe. That's really the first domino, and the only thing that really matters to me is Europe's got to change direction before the U.S. can. And this chart really shows us a big reason why, essentially since the 2022 invasion by Russia, of Ukraine, this currency and this soft red wheat market has been really, really closely tied to one another. And so we really need to see the ruble go up against the U.S. dollar, not just the euro, not just the Chinese currency.
Well, I'm thinking of currencies too. You did send me this, and I don't want to lose sight of this, but just thinking about this global economic picture, Turkey, for instance, holding rates 50% for the 5th month. I mean, it's just, again, more headlines like this, Mike, it speaks to that current economic situation globally.
Yeah, these are green shoot stories here. What I mean by that, Jesse, is when Turkey says their inflation is going down and our inflation is going down, but especially the emerging market inflation, if it's going down, they don't have to keep raising rates to kill the inflation and support their currency. they can spend that money in their real economy. And that's the heart and soul of why funds like a strong emerging markets economies and why they go after commodities typically when emerging markets are doing well. But it really starts with the interest rate and the inflation. How much money do those emerging markets have to spend, to give to their consumers, to increase domestic demand? And on a similar vein, we're hearing now that China may come out with direct vouchers straight into the hands of their consumers. That I think would do immense help and gains in terms of killing their deflationary mindset and really helping the commodity bearers get away from that 2015, 2019 mindset. So I see a lot of reasons why we could be putting in some major cycle lows. And if this Canadian rail thing goes into a true strike and it lasts, I could see it being very painful for commodities, like the pandemic was very painful for commodities. But then all of a sudden they realize, hey, we've got corn and beans rotting in the field in the United States and Canada. We can't move anything. We're running out of supply. And all of a sudden you see this terrible rubber band reaction to the upside potentially, I think. And we've got to be really on point for that if it would happen. So this is the next step in terms of the analysis here between now and harvest. Just another new thing to throw on top of the fire.
No, absolutely. And we hope that we don't see this rail strike, of course, and we hope that the parties can resolve it. But we know that they've been negotiating now for months and haven't gotten to a conclusion here. So we're going to watch this story. I would agree with you, Mike. I think it's going to be very impactful, and hopefully, if it does take hold, it doesn't last very long. We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Mike, let's touch on corn and soybeans a little bit and pull up a chart here, looking at some of the Gulf prices on corn specifically. Again, it felt like a pretty quiet trading session Wednesday. It's kind of been that way for most of the week. Outside of Monday, we got a little bounce to start the week. What's your perception in the row crops right now?
Yeah, my perception with the corn is that it's directly tied to not just the crop tour, but it's also tied to this weather as well, because there's a lot of variability and a lot of young corn out there, Jesse. A lot of pencil ears out there ready to develop is what I saw last week in the central and eastern corn belt. I would also say that the wheat market has the corn essentially by the throat. And this chart really shows you why. And I put this chart in at kind of last minute because Ukraine and their agriculture ministry just came out with fresh numbers. They did take their wheat export number higher than USDA's export number from last week. So that European Black Sea relationship still very valid. The currency means even more under that kind of circumstance. But that same ag ministry also took the corn export number down to 24 million metric tons. USDA has the corn export number at about 20 to 22 million metric tons is the thought. The USDA has exports at 24 million tons, and the USDA's production for Ukraine's at 27 plus. This morning, the Ag Ministry came in at 25 even. Look at how cheap we are in the red for the U.S. Gulf of Mexico price of corn versus the Rennie Ukraine corn export price. We're now over $10 a ton cheaper. Look at where we are compared to Romania. We're working on almost $40 a ton cheaper than Romania. Look at where we are versus Brazil's Paranagua price, looking at about $20, $23 a ton cheaper. This really speaks to the idea that, and this is some of the discussion I've had with some of my colleagues in the media, some of my clients I've had about, is USDA's average corn price of $4.20 still a valid number, or is that going to go down because the crop's going to get bigger? This chart speaks to the upside potential for corn demand if we can get that dollar to break and stay down, especially going into the second half of the 24-25 marketing year.
I think another facet to this too, that we could spend an hour on this discussion probably, so maybe we'll save it for another time. But some of that standoff between farmers and end users right now, I've seen some reports that there's a lot of end users, a lot of elevators, co-ops that are, 9-10% of their normal expected total for what they've bought from farmers at this time of year. So there's still a little bit of that standoff going on right now as well, Mike.
There very much is, and I think this is where it goes back to the on-farm storage in terms of corn and beans in the June report. and the percentage the on-farm storage was higher than what the trade was expecting. But I got to think a lot of that's already priced in at this stage of the game, especially when it comes to the actual physical cash price of corn. And I think that's where, if you look at the national corn price right now, the DTN National Corn Index, in other words, you're talking 360, 370 right now, whereas the USDA's average corn price is at 420. I think that disconnect speaks volumes to what you're talking about, Jesse.
Let's talk cattle too, and I want to make sure we have a little time for that. As you brought up the potential of the rail strike here, and again, I didn't think about that. This cattle market, I'm a little worried that maybe the bull runs over in terms of futures. I know cash is a little different story still. What's your take on what we're seeing in cattle here the last couple of days?
Yeah, almost the exact opposite of the corn in what we're facing as far as the cash price. Even hogs, the cash index at the Merc is 89. We're trading 76 in lead month futures. Feeder cattle, 243 index last published against a 239 futures. That's pretty close. But then you look at this fat cattle chart. We just updated this in the afternoon, early afternoon. Went from 190 in negotiated cash. That's your left-hand scale in the white. It went from 190 down to 186.40. I'm not surprised that we slipped about $3.5 because the Labor Day holiday is over with. The buying is done at this point for the summer grilling seasonals. But by the same token, even at 186 plus, you're up against a 180 August cattle price and a 176 October cattle price. You've got a big discount in this futures market. And I think that 185, 186 level is a strong support level in physical steer cash prices. And remember, USDA is at 193 for the third quarter cash steer prices. So that would be up against your October and in between your August and October. So my take on this cattle market is feeders can lead us lower. That's what they've been doing, especially if the corn turns higher. But at this stage, we've got some real solid numbers underneath us on the cash side of the equation. So I'll hold back on marketings in fat cattle. I'll hold back on marketings in hogs in this next 2 weeks, for the last weeks of August. But for feeders, I would get some paper positions underneath me, especially if we saw this rail strike start. And if it wasn't over by Friday afternoon, I think you really want to make some hedging plans.
Mike, awesome stuff as always. Final thoughts, anything you want folks to really take home here this week?
I think we'll pick up where we left off last week, Jesse. The doom and gloom mindset has to be avoided, especially with what's going on right now. And I think this is where it's a lot like the late 60s, early 70s, that inflation's lingering. And that's not bad because it's coming down slowly and it's bringing the emerging markets back around. But it's also bringing the dollar down because the Fed is realizing that jobs are getting hit by that same inflation. So I'd say cycle low is something we may want to start talking about as we get closer to the harvest time period and wheat still leads.
Mike, if folks want to reach out to you, take a look at your analysis and more, how can they get in touch with you, sir?
GlobalComResearch.com is the best place to go to sign up for a 2-week free trial and take a look at all our services.
GlobalComResearch.com for more. With that, Mike Zuzolo, Global Commodity Analytics. Thanks for joining us this week, sir. Have a great one. We'll talk to you soon.
You too, Jesse. Thanks so much.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.